I got a quote for you today. The farther you look back, the farther forward you are likely to see. Let me just say that one more time. The farther back you look, the farther forward you are likely to see. That's a Winston Churchill quote. I do not have a cool accent or cigar in my mouth to really make it memorable, but I think that's a great starter for how we think about it, because we have to look back in order to inform how we expect our performance to be going forwards. I'll let you maybe kick it off with a little bit of your background, and then we'll go from there.
Yeah, just on that front, the quote that you mentioned, I think it's really interesting. I think it really does. It's a great visual of or description of our investment approach, because it's very evidence driven. I think if you look at a lot in the industry, it's very forward looking. We think this is going to happen. This is why we're going to invest that way. We tend to be much more data driven, and data, it's typically backwards looking. You want to look and see what happened over history, and because that does tend to, as Churchill said, does tend to repeat. So I'm excited about getting into this today. Just a little bit about my background. As founder of Greenspring, I've been really involved in the investment process here since the very beginning. I've chaired the investment committee over a number of years. But prior to that, I started at an organization at a really big bank that was a little bit different. And as far as how they invested, it was more of a sales, how do we sell products to clients? So there was typically a story or a narrative that they really focused on. I saw, part of the reason I left that environment was I just saw that it didn't work very well. And so one of the things that was really interesting to me was what actually works if you really get into the data and the research, and how can we bring those types of solutions to our clients? So for me, the last 25 years of my career, for the most part, has kind of gotten me to that point, although maybe the last 15 to 20 years have been really focused on the data and the evidence and really digging deep. But I think that came out of an environment where I saw things not working, and I wanted to try to fix that. So that's my background.
Yeah, it's seeing both sides of the equation. And my background, I spent about a decade at an institutional asset manager, so helping to understand the research. Right, we worked with Nobel Prize winners, and then go out there and implement the research. But that's at the highest level. And there's kind of this dichotomy. There's how do you build a portfolio not knowing anything about the end client? And that's one thing. And then there's kind of what we do here at Greenspring, which is how do we take all the science and all the evidence, like you mentioned, that we've learned, but then how do we build the perfect portfolio for you and keep that portfolio on track every single day? So maybe before we jump into how we invest, probably the most important thing is, why do we invest? So I'll tee you up to maybe talk about why investing is so important.
Thanks. I think really it comes down to our core purpose, which is to help every person live their ideal life. And for most people, they need resources to be able to kind of do the things that they want to do, whether that's retire one day, send their kids to college, buy that second home, whatever their goals may be, leave a legacy. And typically you want to have some level of wealth to be able to do that. And, there's things that work against you, like inflation, that erodes that wealth. So we need to make sure that our clients are keeping up or hopefully exceeding the cost of everything going up in this economy. So investing is the best way that we know how to do that. And, while there's the elements of financial planning that I think we could talk about at another day, this is going to be, once you start saving your money, what do you do with it? How do you make sure you keep pace with inflation? How do you make sure you can accomplish your goals with it? And investing is really one of the keys there. And so that's really why we do it.
Yeah, I think it's, how do you have your money work as hard as you work, right? Because if you think about your life cycle, it's very early on. A lot of your value is your future earnings. But as you progress through your life cycle, what you're thinking about is, well, I'm going to have less future earnings going forward, and I have to have more capital built up in order to live the life that I want, provide for my family, do all these different things. So investing is the function that gets you there. And I kind of think we live in the golden age of investing. There's so many different products available. There's so many different tools. There's so many different options, and they're lower cost than they've ever been. But what comes with all those options creates a bunch of different hurdles, and you got to try and sort through, hey, what's the best for me, not for the person selling the product, which is kind of what you alluded to at the very beginning. And it's maybe one of the traps of the industry. So let me just turn it back to you and think about, what is our investment philosophy?
I think it starts with a really, what seems to be simple premise that has, I think, far-reaching implications. So the simple premise is that we truly believe that markets work. And so most people, when they hear that, they nod their heads and they go, I agree with you. But they tend to act totally different to that. So let me explain kind of what markets work means. We believe that the price of a security, as you're looking at the stock market, whether it's an individual stock or an index or whatnot, we believe that the price is the best reflection of the value of that company. Because when you think about it, you have a market working to set that price. You have millions of people every single day that are buying and selling and trading that security at a certain price. And over time, that should average out to be a fair value of that stock. So, when I look at, Apple and I see it's trading at $220 a share, I'd say I think that's the best value for Apple, because I know there's buyers and sellers that are setting that price every single day, and they have lots and lots of information about what's going to happen with Apple in the future. Where kind of the difference is there is mostly in the industry, kind of the traditional way that I was brought up, and realized there are some flaws in this, is more of the kind of the talking heads and the active managers that are out there that are basically saying, I know Apple's trading at $220 a share. I think it's underpriced. It's a buy right now. It's going to go up in value. Or the flip side is it's way overpriced. It's going to come down in value. When people say that, and most people take it for kind of gospel, they hear somebody, they say, oh, they have a good narrative, a good story there. One of the issues is what they're saying is, I think the price is wrong. The millions of people that are setting this price are wrong. I, as one person, am right. And, initially that might be an okay way to think about things. The nice thing is that we have a tremendous amount of data now to take a look and see, can people that are trying to guess the price and buy or sell based on what they believe to be under or overvalued securities, how do they do? These are kind of what the industry calls active managers that are buying and selling. And the data is pretty damning. When you get into lots of different studies, whether it's be the S&P or Morningstar, they all kind of say the same thing, which is 60, 70, 80% of all managers in a given year fail to underperform the benchmark or an index. So I think what we see is that markets do tend to work over time. It doesn't mean that prices are always exactly right. It's just our best estimate of what prices should be. We don't know a better way of doing it. So it leads to really trying to avoid managers and investment strategies that are all about picking the best stock, getting into the market at the right price, or getting out at a different price. It'd be one thing if you could find somebody, or you could do it effectively over time. We just have not seen anybody do that. So we believe that markets work, and we invest accordingly.
Yeah, and to your point, it is a very freeing philosophy. We're in the process of buying a row house, and I was talking with somebody, and they said, "Hey, did you get a good deal?" I don't know. I got the fair price. Somebody else bought a different row house that looks exactly like ours for the exact same price 3 months ago, and it's one of the biggest purchases you're going to make in life, and you can live free knowing I got the price. I didn't have to fight for a great deal. I didn't have to go through this effort. I could go and I can live my life. And you kind of talked about the underperformance of active managers, and it's, on average in any given year, they're underperforming. 60% of them underperform. When you start stretching out that time horizon, it gets incredibly damning. It goes to 90%. underperform, right? Only 10% are outperforming out to 20 years. And that's on a pre-tax basis. So taxable investor, it gets even worse. But there's this framework that I find is like incredibly helpful to think about how to build a portfolio. And that's the three sources of alpha. And alpha is finance speak for outperformance relative to your next best investment option, which is always kind of an index fund. It's an experience that most people can invest long and get a great outcome. So there's kind of these three sources of alpha. There's the traditional, the stock picking alpha, which is what you talked about. The evidence is very clear. It's an incredibly tough game, and it's only getting tougher as information moves quicker. It's tougher to compete on informational advantages. The second is what Bob Merton calls risk-based alpha. So this is, can you take a risk that some other investor doesn't want to take? And that's a source of alpha relative to your next best option. And then the last is financial services alpha. So this is thinking about, can you avoid a cost that everybody else has to bear? These are things like taxes and implementation costs. And that's something that as advisors, we can think about how to build portfolios and implement really well every single day. But there's these three different sources of alpha, and this is what everybody's focused on. But I always go back to this one quote that I think is so powerful, and it's Morgan Housel. He's an author, he's an investor. And he kind of says his investment strategy is to be average for an above average holding period. And what he means by that is, since most people are out there trying to outperform, and they're actually underperforming, if I can just aim to be average, but I can do that every year, I'm going to end up being one of the best investors out there. And he kind of gives this example that Howard Marks gives, who's a famed investor, and it's talking about one of his friends that over a 14-year period was never in the top 25% of investors. But in each given year, but at the end of that 14-year period, he was the top 4% of investors. So he's never in that elite group, but because he could stay invested over time, you can end up having these fantastic results.
It's great. It's great quotes, great examples. I think just to expand a little bit about the three sources of alpha that you mentioned, the one being that we tend to avoid, which is trying to pick stocks or market time, basically get in and out of the market at opportune times. Just a quick story on that. I mean, I think the challenge with that is A, doing it, or B, trying to pick, maybe more likely for most investors, pick a manager who has done it in the past or thinks they could continue to do it. Most people will pick managers based on their track record. That's a typical way to do it. That's how I was taught at a big bank, was choose managers that have great track records. They're easy. That's an easy sell to a client. Somebody has done it in the past, should do it in the future. And it really comes back to, is the outperformance that you're looking at in the past, is that based on luck or skill? That it's a really important concept for people to think about. My kids a few years ago, one of my boys did the stock market game in high school, and he picked two stocks, and he did amazingly well. I can't remember what stocks they were, quite honestly, but they were stocks you never heard of. They were like penny stocks, and they went up, and it was over the course of about a month. And obviously he thought he was a genius. I think anybody looking at this objectively would say that is pure luck. He knew nothing about the stock market, but he had outperformance. So if you were looking at his track record over the last month, if you were just looking at track record, you would say, wow, this person is really good at investing. At what point does it move to skill, where you would say, oh, this person is really, really skillful? Well, there's been a bunch of research on this and statistical analysis, and it usually takes dozens and dozens of years and decades. And for most managers, they don't have that long of a track record to even work. So it is really, really tough to distinguish skill from luck. So I think that's the first thing there, is when you're looking at a manager, if you're thinking about, I want to try to outperform by picking a manager that can pick stocks or whatnot, really dig into the data and the evidence of, is it skill or luck that this comes from. The second part of your alpha that you were discussing was these kind of risk factors, if you will, which is, are there areas of the market that tend to do better than maybe the broad market itself? And there's actually a lot of data and evidence that we can point to, and we can look at to kind of to exploit that part of investing. So probably the biggest ones that have been around for a while are things like small companies versus large companies. Small companies over history, over time, almost the last 100 years in the US at least, have had a higher return than large companies. And another one would be value, or companies that are cheap relative to some some metric like earnings or sales or things like that, compared to expensive companies. Cheap companies tend to do better. If you can buy them at a cheap price, do better than expensive companies. So, I think those things are important to understand those concepts when you're building portfolios for clients. Is, if I want to avoid kind of the thing that doesn't have a great track record, which is, managers that are trying to pick stocks. Okay, that's one thing. But if I want to try to enhance returns and maybe outperform even the market, what do I focus on? It's these things that have a long-term track record of outperformance. And I'll just use a quick example of small companies versus large, maybe to kind of express this. And this is just more of a thought experiment, but let's just say, I'll use that example I was using before. Apple is maybe one investment that you could choose as an investor. And let's say I gave you $100,000 to invest, and I said you had to pick one investment. Apple's your one option. That's going to represent the large company. And then I'm going to use an extreme. Let's say you had a friend that had a startup company, and they are looking for capital to help grow. That's your other option. And if they both came back to you and said, Marcus, we really need your capital to help us grow and grow and expand. We're going to give you a 10% return if you invest with us. Well, you would probably think about that for maybe 30 seconds, and you would say, well, if I'm going to get the same return, Apple's been around for a long time. I think it's going to be around for a long time. I'm going with Apple. Your friend's startup could be out of business next month. You're not going to, if that's the same return, you're not picking that investment. Now, your friend may know this and may say to you, to attract your capital, I'm going to offer you a 20% return to invest with us. You might start to think about it at that point now, because you might say, well, okay, I understand it's a lot more risk associated with this, but I'm getting a higher return or higher potential return. And so that's really kind of why things like risk factors work, is that, you have this, in this example, large and small companies. You could get a higher return with small. It doesn't come for free. You have to accept higher volatility, higher potential risk of loss. But that's a decision point that, from an investor standpoint, and we as a firm really focus on, is what's the right mix of small companies versus large, because we know it's going to impact returns, but we also know it's going to impact risk, and we have to deal with that within the context of our clients' risk tolerance and things like that. But that's an important area where I would say there's a lot of evidence to suggest that is a factor that will help us outperform. We're going to focus on that versus the areas that might be fun to talk about, like which is the best stock to invest in, but don't really have any evidence of outperformance.
Yeah, it's such a great example to think about the theory, right? Why would we wouldn't expect all stocks to have the same return. So why do you expect different stocks to have different returns? And then you go out there and you study it with as much data as you have. And we have over 100 years of US stock market data where we can look at these trends. We have 1,000 years of interest rate data. We can look at the Bank of England's loans back to the 1100s, right? So we have these massive time periods where we can try to understand what drives returns. And then the question that it really leads to is, how do we stay invested to capture these returns when we don't actually know what's going to happen tomorrow, because it hasn't existed, right? There's going to be some news that comes into the markets that's going to affect the price, and then we're going to have to figure out a way to move forward. So maybe kind of one of the things you alluded to was you have to think about risk as, well, it is a little bit riskier, so how do you manage that? And that kind of gets into three kind of primary drivers around why active management has underperformed to such a significant degree. And those three kind of primary things are costs, they're expensive, risks. They take highly concentrated risks where, in your example, it's like, I might take Apple at 10% over a startup at 20% because I still think in 10 years Apple will be around. I have no idea about the startup, right? So you got to think about, okay, well, maybe I have to invest in 100 startups, so risk. And then the last is taxes, which I think is a secret of the investment industry, that everybody shows pre-tax performance, but that's not what most investors care about. They care about after-tax wealth. And it's this massive disparity between the numbers they're showing and the numbers people are realizing. And if you're not looking at that, trying to evaluate somebody, the returns an actual investor kind of consumes in economic parlance, it's not effective. So those three things: costs, risk, taxes. Let's dive into each of them. What are the major costs that you see from the investment landscape?
So, there's a number of, I guess I'd call it explicit costs that you can see. You're going to see it in your portfolio. And then I think there's implicit costs that are harder to see and harder to understand. So maybe we start with the easier ones. Explicit costs, those are going to be things like trading commissions. If I'm buying and selling and I'm paying a commission, that's going to be an explicit cost. I'll see it right on my statement. Here's what I paid. You're going to have expense ratios of any funds, ETFs, mutual funds that you are investing in. And that will be not as explicit because you're not going to see it on your statement, but you can go on to Morningstar.com or any other website and find the expense ratio, and it's going to be stated as a percentage. And that's a percentage of your assets that the manager is taking to manage those assets. So those are probably the big explicit costs that you would tend to see. Also, if you're working with an advisor, you're going to have an advisory fee that would also be factored in. Some of the implicit costs will be things like the bid-ask spread, which sounds kind of complex, but really what that means is if I'm using Apple as an example and I see that it's trading at $220 a share, well, there's a bid and an ask, and I'm going to pay the higher price, the bid versus ask, and the seller is paying kind of the getting the lower price, and that spread between the two is how the broker's making money when they're doing that. So in certain investments, there's a very narrow spread. You're not losing a whole lot from a cost perspective. In others, we've been talking mostly about stocks here, but if you get into things like bonds, especially, you can have really wide spreads, and you don't really understand. If you don't understand that, you can lose a lot of your returns from a kind of this cost, this implicit cost of the spread. So you see it in stocks, you see it in bonds. Those are some of the implicit costs. Anything else that I'm missing there, or any other thoughts?
Well, I think just kind of expanding on how big some of those implicit costs can be, the difference between the bid and the ask. Apple, it's probably going to be pretty tight, where you're only going to run into issues if you're really frequently trading, if you're a day trader. If you expand to other things that people are day trading, things like options, near to expiration, you could be looking at 13 to 25% of the value of the investment could be between the bid and the ask in that. If you're thinking about bonds, municipal bonds, it could be multiple percentages. And what's crazy about the bonds is if something's yielding 3% and it costs you 1%, 2% to trade that, that's kind of your whole year expected return being eaten up on one trade. And it's just intricacies of each market. You got to kind of understand, hey, how does this factor in to each market? And then the more esoteric you get, the weirder these costs become, right? And you kind of mentioned expense ratio, but what you might also see is, especially in the private market, space, you're going to see a lot more fund-to-fund fees that are titled different things. So if you have a fund that's investing in another fund, you're going to pay some of those fees as well on top of the fees you're paying. And so it kind of just stacks. If you think about leverage, I'll give an example. If you're buying into a strategy and the expense ratio is 2%, but there's 50% leverage, you have to ask yourself, what is the expense ratio being applied to? Is it being applied to just the money I put in, or the money I put in plus the leverage? Because in a sense, your fees could be about 50% higher. So there's all these different considerations. And then maybe the last one I would point out that I think is really, really critical, and that's this concept of closet indexing, which means, are you paying a high fee for somebody to invest in something very, very similar to an index? And in a sense, you're paying maybe 1%, maybe 0.5%, but half of your portfolio is something that you could do for 0.02%, right? 1/25th, 1/50th of the cost. And so the question you have as an investor is, why would I not choose to separate those two things? And this all gets to the complexity of all the different options that are out there. So there's a bunch of different costs. Costs matter.
One of the things that I hear probably most often from clients and investors is, I don't mind paying a high fee if I can get a higher return, and the return that I get exceeds kind of that fee that I would pay. And that's a pretty common refrain I hear from most people is, I don't mind paying the fees if I'm getting high returns. And I think there's a little bit of a flaw with that, which is kind of goes all the way back. And this is why some of this philosophy is important, and the why is it builds upon itself as you start to think about, what do we truly believe? Well, if you believe that markets work and it's really hard to outperform, what that doesn't say is there won't be managers that outperform. It doesn't mean that. There will be managers that outperform. The question is it luck or skill? And we believe, in nearly, almost all the cases, it's luck. So should you be paying a high fee for someone who's been lucky in the past? That has no real evidence that they are going to continue that. So I'd rather control what I can control, which is fees. And I know over time, those things are going to probably work themselves out. That manager that's had high performance, on average, you would expect, that they would start to kind of look more like the average over time, and those fees will really start to eat in to their overall returns. But that's an important distinction, I think, when you're looking at performance and you're looking at fees, is this idea that, I'll just pay more. I don't mind paying more because this manager's outperformed. One of the best examples, we're here in Baltimore, and there was a manager that outperformed the S&P 500 for 15 years in a row. And I remember, he was just a staple here in the community. He still probably is to a degree. Everybody knew he was. Everybody owned his fund. But the fees were approaching 2%, towards the end of his tenure of his run against the S&P. Well, he turned around the next, few years. He basically gave all of his performance back and then some. And it turned out it would have been, 5 years later, it would have been so much better had you just owned the index. But a lot of that was around the fees. I mean, 2% compared to, like you said, 0.02% is just a massive difference. And it doesn't sound like much, but when you start to compound that, it is a really, really big deal over a long period of time.
Yeah, and the last thing I would say, luck versus skill, because it's a very emotional topic too, right? If you say, hey, you've only achieved your success because you've gotten lucky, you look jealous. I don't like that. But the question is it repeatable? And I think, let's say it is skill. How important am I as the investor to that? I'm not, right? Who's important is the person that has the skill. And actually, my money is very cheap to them. If I don't invest, they're going to find somebody else who will, because they have a bunch of actual skill, right? So in that sense, one of the real dangers is, let's assume they do have skill. They're going to be the ones to capture the upside because they have the scarce resource, not me. Because there's a lot of different people of my net worth that they could turn to fund their enterprises. So let's jump to kind of the second key consideration, which is risk. Risk matter. And kind of the way to think about this is if you break apart all the different pieces of the market, they're all riskier than the market itself. So how you think about taking risks, and probably the best hedge against uncertainty of investments is diversification. It's kind of like referred to as the only free lunch in investing is the ability to diversify. So Pat, when you hear diversification, what jumps into your head around what's the proper amount of diversification?
Yeah, so I think there's a couple probably levels you can think about diversification on. So let me talking about maybe first at the portfolio level of just asset classes. And the last few years have been a great example of this, where if you took an asset that was considered to be the safest asset, which is bonds, and you were having invested in that over the last 3 to 5 years, you would be approaching a negative return, somewhere right around flat to slightly negative returns over the past several years. Whenever you put all of your eggs in one basket, I don't care what that basket is, there is risk associated with that, even if it's in the safest investment that you could find. So I think that's important. I've often told clients, even if you want to be, have the lowest volatility with your portfolio, most likely that's going to have some element of equities in it. Because the last few years is a great example. You had this rising interest rate environment, falling bond prices, and anybody that was 100% invested in bonds have had a really terrible return. Now, at the same token, the last 3 to 5 years in the stock market, it's done very well. So I do think having diversification amongst asset classes that are very dissimilar from each other is going to be important. When you get down to the portfolio level the kind of asset class level, then let's just maybe look at stocks. Well, now you have a lot of different options on how you invest here. Some people might take the approach of, I'm going to pick the best 50 stocks that I can find, and that's going to be diversified. Well, there's literally tens of thousands of stocks that you can invest in. We're a believer that you should invest in most of those. Why not? Concentrating your assets in just a small percentage of those, or maybe in a region, maybe only in the U.S. or only, if you're live in Canada, maybe only in Canada or something like that. There's risk associated with that as well. Markets are going to move differently. There's different currencies. There's so much diversification value you get. So we're a believer that you should invest in the majority of the equities out there. There's definitely cases where you'd want to avoid some, and we do. But for the most part, our portfolios have over 10,000 securities that are kind of, if you were to pop the hood of the funds that we own, it's going to have a lot of securities in them. And we believe that we can diversify out any single stock risk, which is really important. When I think about our portfolios, we're going to have, I don't know what the percentage is, but some not zero number of companies that go bankrupt every year in our portfolio, go to zero. And our clients will never know it because it's such a small percentage of their portfolio. On this other side of it, they're going to have investments that go up hundreds of percent per year in a given year. And they're also not going to know it because it's a small percentage. So you've basically diversified out all of the risk of owning a single stock or a small kind of concentration of stocks. And now I just own the market. And again, if we're looking to try to get higher returns, instead of trying to concentrate our wealth, which is a high level of risk, we don't think you get compensated for that, because how do we know which stocks to buy or sell if we believe markets work? So we're looking at it saying, let's own all of those stocks, and we're going to own them in percentages that allow us to be able to capture things like small company returns over large and value company returns over growth. And we can do that over a portfolio of thousands of stocks, so we're not taking massive risks and being concentrated.
Yeah, and to build off of that, I think there's some other interesting components where a lot of times mentally it's helpful to bucket things, right? So I show up to my job every day and I work hard, and then I invest. And in reality, a lot of those are correlated. So it's like, you also have to think about, hey, what's the riskiness of my job, and how do I want to tie that to my investments, right? Because the whole point of your investments is so that at some point in time you can spend that money. That's why we're actually growing it, so you can do more things with it. So if you have all your money in the US, then what happens if the US happens to have a tough time period and your job also has a tough time period? It's helpful to think about what's my whole financial picture as well. And then last thing that is, I think, one of the magical things about markets work and risk is it helps you understand, relative to the market's definition of risk, how much am I overweighting this company, right? So when we see portfolios come in, there's a few things we might see. We might see a bunch of different managers, but when you look at the underlying stocks, you might see a ton of concentration, right? Different names on the portfolio doesn't mean that they're not holding the same thing. And then what you could do is you can look at those actual underlying holdings compared to the market weight, and you have a reference point for how much do you really believe in this idea. And if you're starting to see holdings jump to 5 or 10 times their representative market weight, it gives you a good sense like, hey, we are taking a ton of risk here relative to what everybody else in the world thinks is the appropriate amount of risk for this name. Like, that's just something to consider. And then just kind of wrapping up on risk and jumping to the last one, which I mentioned, was like the hidden feature of investment sales is nobody talks about taxes from portfolios. And that is huge. There's research out there that shows it's about 1 or 2% typically per year for these active funds that you kind of don't see until you invest in it. And that's another major hurdle that you have to be super cognizant of as an investor.
Yeah, taxes, no one talks about them, and clients don't typically even understand it until maybe they get the end of the year. The following year, they get their 1099 from their broker, and it says, you have, whatever it is, $50,000 of capital gain distributions that you're going to need to now pay taxes on. So it's tough for investors to measure that and figure out exactly what am I losing to taxes. But to your point, there's been research out there, and it does show that it's significant. And so there are things that we're doing as the advisor to try to really minimize. We can't avoid taxes completely if the portfolios are going up in value, but we can do our best to really minimize that. And maybe I talk about a few different strategies that we employ to try to be able to do that. So first off, the vehicles that you use are really, really important. If you are using vehicles that are less about trying to buy and sell stocks all the time, and that's the active managers, they're going to be trying to select the best investments and sell the ones that they think are going to be, not going to do well in the future. Depending on their strategy, they may be doing that daily, they might be doing that monthly, but over time they tend to be doing it. And therefore they're creating gains or capital gains inside their portfolios that have to be passed through to shareholders of those funds. So we're trying to avoid those funds. We use vehicles that tend to be much more efficient from a tax perspective, whether it be the structure of those vehicles or how they're investing those funds. So our hope is that we can really avoid paying capital gains taxes on something that we haven't even sold in the portfolio. Now, obviously, if a client is in a situation where they are withdrawing money from their portfolio, or we're in a situation where the portfolio has become out of balance and we really believe that it makes sense to sell a security to get it back into balance, to rebalance a portfolio, we're looking to do that in the most efficient way possible. We want to match up gains and losses. We just got through the end of the year. That was a very big kind of push for us, is making sure we're minimizing taxes wherever possible. And then the other one that takes a little bit more time and effort to really understand is where you own your assets. So you have certain investments that are really inefficient from a tax perspective. When I own a bond, for example, almost all of my gains are going to come from the interest income off of that bond. So when I'm looking at, maybe I'm earning 4 or 5% on a bond, if 100% of my gains are going to be taxable to me, I'd probably rather own that inside of a tax deferred account where I don't have to pay the tax on that every year. So that's typically a pretty basic strategy on where do we want to own an asset. There's other assets that are really tax efficient. So if I own a stock fund and I'm not planning on selling it, if that fund I buy for $10 and it grows to $14, I've made $4. Well, if I don't sell it, I don't have to pay any taxes. I can own that inside of a taxable account. And I can control when I buy and sell that hopefully will control the overall tax ramifications. So it's a interesting, there's kind of the philosophy around how we do it. There's also every client's going to be unique in this situation because they're going to have different tax circumstances, not just as a client, but every year too. You could have a client that loses a job one year and they have a stretch maybe for 6 or 8 or 12 months where they don't earn a whole lot of income. Well, there's all sorts of strategies we're doing around that to try to optimize the portfolio for taxes. And I think that's really important. So there is kind of some broad tax strategies that we're using internally for every client. And then on an individual basis, our advisors are working with their clients each year to make sure we're taking advantage of their particular circumstances. So taxes are the one thing that are going to be unique to every client. Everything else, if you buy a fund, if I buy Fund A, and some other investor buys it as well, they're going to get the same pre-tax return, but we're going to have different after-tax returns as investors based on our own circumstances.
Yeah, and I think what you're also leading to is one of these challenges. I think when somebody's thinking about investments, they're thinking about what's that one amazing decision you made, right? What's that one stock that you bought that happened to do really well and all the focus is on there. But kind of what we've learned looking at all the research is that when you focus on those one decisions, you ignore all the little decisions that you have to make every single day. And in actuality, it turns out that there's more value to be had by focusing on each of those small decisions every single day. I'll give an example. You think about an investor that did very well with NVIDIA. Okay, that's fantastic, and we're very happy that she had a great outcome. But they're thinking about this question, luck for skill, and they're wondering, how do I repeat the success of NVIDIA? So what are you going to do? You're going to build up your cash to go find your next NVIDIA. Well, that whole time you're having cash drag on the portfolio, right? Your cash is maybe keeping up with inflation and taxes if you're lucky, probably not. And these are the costs that are very hidden to the individual investor because it's tough to think about, well, what's the opportunity cost of that cash? We could have been investing it in the broad market, which has also gone up a ton, not as much as NVIDIA, but a ton as well. So there's so many small decisions on the portfolio management that you can take every single day to better your portfolio positioning and kind of reduce some of these hidden costs that might not be as clear.
Yeah, I agree. There's kind of sticking with the costs and the risks theme of kind of these things that we want to be looking at regularly, and probably going to your example a little bit. One of the things I tend to see a lot is people misunderstanding the idea of making a good decisions and outcomes. Let's put it that way. So, I'm not really a gambler, but every once in a while I'll play poker or whatnot. And it's maybe the best example is if you're playing blackjack and you get a really, dealt, a 5, for example, and, and the dealer is showing, the same, something like that. If you, there's certain things that you do that are going to be the right decision there. And, you may lose. The outcome is somewhat, you have to be kind of careful of divorcing. You should be kind of divorcing the decision-making with the outcome because, I can make the right decision, but lose. And also I can make the wrong decision and win. And to your point, sometimes when somebody's buying an individual stock, we would say, and they've had a great outcome, you kind of have to look back and say, is it the outcome because I made a really great decision here? Or I make maybe a not great decision, I just kind of got lucky and had a good outcome. So and that's a really tough thing for people to understand, because most people are going to equate outcomes and decisions the same way. They're going to say, if I had a good outcome, I made a really good decision. And if I had a bad outcome, I made a bad decision. That is not always the case. Our goal as investors is to consistently make really, really good decisions over time. It doesn't mean every decision is going to, 1 year later, you're going to look at it and say, oh, I had a great outcome. But if you do it over time, you are going to be successful. And if you do, the flip side is, if you make bad decisions over time, you're going to have some good outcomes. But I would expect over time that the aggregate of all that is going to be worse than somebody who consistently makes good decisions. So trying to kind of look at things based on what's the best decision right now to make versus judging outcomes only is really, really important, I think.
Yeah, and I think the true question is this repeatable? If I made a decision and I had a great outcome, can I evaluate my decision-making process to figure out, can I make that same decision again to have the same outcome? And that's really the difference between luck or skill. If you can't repeat the process, it's luck. If you can repeat the process, it's skill. And when thinking about investments, there is things that are repeatable, right? Putting tax-efficient investments in taxable accounts, putting tax-inefficient investments in non-taxable accounts. That's a repeatable skill. Making sure your cash is invested, that's a repeatable skill. What's less repeatable, and this is not our opinion, this is what the research shows, is trying to predict what companies are going to do great in the future. There's this concept of pricing in perfection, where certain companies have done great, their earnings have risen tremendously. The new price reflects that, right? It doesn't reflect a new shock to their earnings. It reflects where their earnings are at today. So trying to think about luck for skill, maybe that's one way, but repeatable versus non-repeatable is another way.
Great. And I think one other thing to keep in mind is, as we are, and this kind of goes back to philosophy, when we're thinking about how we add investments or make changes to the portfolio, one of the things we're looking at, again, is this repeatable? And so if an investment requires manager skill for it to be successful, we typically will not invest in that investment. So if it requires a manager to be really good at picking investments, we don't believe that's repeatable. So all the investments we have, if you had manager A and they decide to retire one day and you slot in manager B, they have a systematic way that they do it. And it doesn't really matter who's in that portfolio manager chair, if you will. We think that's really important, because managers don't last for, if you're picking a manager or a fund that has a track record because of a great manager skill, at some point that manager is going to leave. You're going to have to then decide, do I get out? Do I stay with this new manager that's in that doesn't have any track record? If I do decide to get out, now I have costs associated with just changing my portfolio, taxes, trading costs. So I think all that's really important when you're thinking about your strategy, because it's going to, when you start thinking about those types of things, it creates turnover and whatnot, and it does degrade performance.
Yeah, I'll go back to something we kind of talked about at the beginning, which is we kind of live in this golden age of investing. I think we've learned so much around what drives returns, what you can expect, what you can expect, what you can control, what you can't control. And really, it's just about, can we implement that every single day, which, kind of gets us to this one point, which is, if there's one behavior I think you can have that will make you a great investor, it's not having this trait. And that trait is the fear of missing out, right? Somebody else is doing really good, and so therefore I have to do the same thing as what they're doing. If I had to ask you this question, Pat, what is one trait you think leads to a great investor? Maybe that's what we'll end on.
Yeah, if I had to pick just one, I think it's somebody that has the confidence to stick with an investment strategy over a long period of time. I think almost every strategy, as long as it's rooted in some level of evidence and research, I think almost every strategy can work. So having the confidence in a strategy that it will work, and I'm going to stick through this, all the inevitable bad times, because no strategy is always good. There's going to be times when the market goes down and your investment portfolio is going to go down or whatnot, or there could be times when some investment strategy that you've selected goes out of favor. But over time, probably the best investment strategy for you is one that you can live with, so that you don't get out of it at a bad time, that the behavioral part doesn't get in the way of your success. So I guess confidence in your strategy would probably be my answer to that.
Yeah, it's an amazing point, because there's probably one truism in the world, which is, in order to achieve, risk and return are related. So in order to achieve a return, you have to take commensurate levels of risk. And I think one of the confusing parts about markets is risk is one of these things where it's always there, but it only shows up sometimes. So it's really tough to visualize what that future risk will be. But the risk of the stock markets tends to be underperformance for longer than people would expect based upon their past investing experience. Now, we hope that doesn't happen. Oftentimes it doesn't, but the risk is always there. And so whenever it comes, you have to be ready to stick with it. I think that's such a great closing thought. Control what you can control, know yourself. And if you do those two things, you can have a great investment experience.
It's great talking to you. Glad we were able to dive into this a little bit more deeply.
Yep. Great talking to you, Pat.